Okay, I think let's begin. Good afternoon, good evening, everyone. Welcome to FSM1 webinar. My name is Sean Lau Tian Hao, and today I'll be the MC for this evening. First of all, I hope everyone is doing well, especially during such tough times. And FSM1 also extends this wish to your family members as well as friends who are facing such difficult situation. So before I continue, I would like to highlight a couple of house rules. The first is kindly mute your mic for a better audio experience, not only for yourself, but also for the many people that are in this webinar. There will also be a Q&A session after the presentation. And if you have any questions, please feel free to type in the chat room during the Q&A session. However, we will temporarily close the chat room and resume it back after the presentation. If you are facing any audio issues, especially, please email us at investhelp.my@fundsupermart.com for a recorded version of the webinar. So tonight, we are very honored to have Mr. Avinash Savalekha to share with us a little bit about the market update of the US equities. Mr. Avinash Savalekha is the country head of Malaysia, as well as CEO of Franklin Templeton Asset Management, Sdn Bhd, and is also responsible for leading the firm's retail and institutional distribution efforts across Malaysia. Mr. Savalekha also continues to serve as the chairman of Vietcombank Fund Management, a joint venture between Franklin Templeton as well as Vietcombank in Vietnam. Prior to this, Mr. Savalekha was a vice president portfolio manager and is a research analyst for the Franklin Portfolio Advisors, which is a division of the FTPA. He was also a member of the Franklin Small Cap Growth Portfolio Management Team and was the lead manager for the private small cap accounts for FPA. Mr. Savalekha received a Bachelor of Commerce from the University of Bombay, India, and an MBA in the finance from the Wharton School and the University of Pennsylvania. He is also a CFA charter holder and a member of the CFA Institute and the CFA Society of San Francisco. So without further ado, let's welcome Mr. Savalekha to give us his presentation. Over to you.
Thanks, Sean. Can you hear me clearly?
Yes, all good.
Okay, perfect. I'd just like to echo the same sentiments as Sean. I hope everyone is safe and healthy and managing through this extended MCO. And I also want to thank Fund Supermart for organizing this call and inviting us this evening. So let's kind of get right into it. I mean, as the title suggests, we are long-term thinkers. We are long-term investors. And in spite of the fact that there is increased volatility, what I'd like you to think about is what the long-term opportunities look like. So with that, let me just kind of put a little bit of a framework for you. I mean, clearly it is a tough time in the global markets. We have had unprecedented levels of job losses, decline in business. It's been unbelievable. It's been incredible. I mean, you can come up with all kinds of different adjectives to describe the situation that we're in. At the core, this is a healthcare issue. Right? I mean, the virus is something that has essentially created an economic downturn. So naturally, there's a lot of attention that's being paid to the health news itself. And that's going to be the one key that you look for to see how we're going to recover, when we're going to recover. Because at the end of the day, this is, I mean, to use a little bit of medical terminology, this is a self-induced coma. So the economies have been put into a self-induced coma by the governments. And that has been done through the lockdowns, through restricted movement, closing off borders. So we're obviously in a time that's going to create a lot of difficulty for the economy and for the people. So how do you kind of invest in that environment? I always find it's helpful to take a bit of a kind of a historical perspective. You go out and you look at kind of what have we seen in the past. So if you see the slide that's in front of you, this is essentially a snapshot of the S&P 500 since 1970 all the way through till current. And what you'll see is in the shaded blue bars, um, the vertical bars, those are the bear markets. So you can see that the bear markets have been fairly short, right, compared to the long-term bull market. And if you look at the long-term bull markets, you're adding in any given bull market, you're adding triple-digit type returns, right? So what is clear is bull markets tend to stay longer, they make more money, and the bear markets are much shorter, right? So if you go to the next, I mean, what we'll see in the next slide is an actual calculation of this, right? So an average bull market, you see 252% increases, and they last about 6 years. And the average bear market drops about 30% and lasts a little more than a year, right? So, and this is the S&P 500 that we've used as a benchmark index to kind of do this analysis. So if you move on, I mean, you're talking about volatility. I mean, you take a look at the next slide. I mean, this is just a simple slide that shows kind of what if you had invested a certain amount of $10,000 in 1970, it would be worth over $1 million right now. So it's, I think the next slide is a little more important. David, if you can move to the next one. So here, what we're looking at is the percentage of time that you're invested, right? So if you are, let's say you're a daily investor, right? A day trader. The chance that you're going to gain in a day is 54%. The chance that you might lose that day is 46%. So roughly even. But if you move that investment time horizon by a month, right? The odds of your gains go up to 63% and the odds of your losses drop to 37%. So if you're like us, which is long-term investors, where we look at 3 to 5 year timeframes, you look at the 5-year time frame, 90% probability that you're going to see a gain. And there's a 10% probability you're going to see losses. So the way I look at this is, in effect, what you really want to do is time arbitrage. And that's what we're doing. When the market is short-term in nature and thinking short-term, you want to extend out your time horizon. Because in the short term, if you ask me what's the market going to do 6 months down the road, the answer I give you is probably going to be maybe half and half correct. But if you ask me what is the market likely to do 3 to 5 years out, I can pretty much guarantee and say it's going to be up, right? Because fundamentally, the economies are going to grow again, right? So just moving on, let's talk a little bit about the volatility. So clearly we have focused on the long term, right? But we do expect volatility in the short term. There is potential for downside in the short term, right? And there are going to be, and the volatility is going to be driven to a certain extent by what happens with the viruses. So the things that we're looking for in terms of stabilization are you start seeing infections stabilize, you potentially get a vaccine, or like what happened in March, people just got, there's just selling exhaustion, and then the market stabilizes, then you see a rally up. But so let's take a look at the health crisis itself, right? Let's start with curve bending. I mean, you've heard these terms. I think now there's so much news coverage of this that I think pretty much all of us have become somewhat experts in viruses now, whether we like it or not, right? So hopefully Asia, where it's all started, is past the peak, right? And the reason I say hopefully is because we are now starting to see, as we reopen economies, as China reopens, as South Korea reopens and comes out of lockdowns, is there going to be a resurgence in the virus activity? So that's why I say hopefully we're past the peak. In the US, obviously New York and the adjoining states on the East Coast were clearly more affected, but we're starting to see improving numbers out of there. In Europe, Italy and Spain, which are the two most affected countries, have started to stabilize and are starting to improve and are actually reopening their economies. And let's look at it closer to home, right? I mean, Malaysia has done incredibly well in terms of controlling it, right? I mean, we're down to now almost 30 new cases a day, which is very, very good, right? So are we looking at reopening? So we've got a conditional MCO now, right? So there are certain things. So if people want to go back into the office, they can go into the office. So that's one step moving towards it, right? So we've talked about how markets are going to be driven by the health news, right? Whether the cases start going up, when we start seeing reinfections, or let's say a relapse or a spike up again, that's going to have an impact on the cases. And then vaccines. A couple of weeks ago, we had really positive news out of Gilead with their drug remdesivir, right? And the first week it was positive news because they were showing some positive signs out of Chicago, in a hospital in Chicago, and then almost immediately in a few days, news out of China where they were testing it said there wasn't really that much of an impact. And you saw the tremendous amount of volatility in the stock price of Gilead as well as in the markets. So there is going to be volatility. There is going to be concerns around whether there is going to be a vaccine or not. None of us, I mean, I would not qualify me as being an expert in vaccines. When you look at the estimates that the health experts are looking at a minimum, it's going to take us a year to get vaccines out, right? Because it's not an easy thing. So that's on the optimistic side. So we're going to be living with this virus for 12 to 18 months till we get fully vaccinated. So what happens in the meantime is going to be a lot of volatility driven around kind of news flow. And I think that's something that you need to kind of understand. And also not be frustrated or spooked by it, right? Keep your eye on the long term. So let's take a look at what the economic impacts are going to be of this, right? So what we are expecting is in the second quarter will probably be the worst quarter of economic news, right? And that's going to be, you pick any economic metric that you want to look at, whether it's GDP growth, whether it is unemployment numbers, whether it's people traveling, all those numbers are going to look ugly. And we've already started seeing some of that in the first quarter, especially in Asia, because Asia went into this in the first quarter. But second quarter is going to be even worse, potentially. What is that? So what have we seen as a response, right? I mean, when you talk about monetary and fiscal response, the US Federal Reserve, the central bank, has been incredible in terms of its response. The US Treasury has been incredible. We're talking about north of $6 trillion being pumped into the economy, right? The central bank has stepped up and has provided liquidity like it has never done before. So these are steps that need to be taken to stabilize the financial system, and they have done that. What it also does on a negative side is create something called a moral hazard, which in effect means that I can take all the risk I want, knowing that the Fed will come and bail me out if there's a problem. And that is not a healthy situation for any capital market. But the way the central banks are looking at it right now is to think about, okay, we've got to get through this financial and economic turmoil right now, and then we can think about how do we unwind moral hazard. So let's take a look at consumer behavior, right? There's obviously going to be a deep retrenchment, twofold, right? One, because of lockdown. So even if you wanted to spend, you can't really go to your favorite mall, right? You can't spend, you can't walk around. So that's not there, right? The second part of it is when the economy shrinks, when companies shrink, there is going to be job losses, right? And so that is probably a second level effect that you're going to see in terms of spending capacity. Now, there's also been a lot of talk, I'm sure you've seen a lot of newspaper articles about how behavior is actually going to change when you come out of this, right? When you come out of COVID-19 and the lockdowns, etc., how is your behavior going to change, right? So what I would say is that there are going to be changes, right? The question is, how are you going to spend when you think about that? That is going to give you an indication of what you think is going to happen in the economy. And then on the corporate health side, you know, we've always looked at strong companies and good quality companies. And the idea being that these have strong cash flows, strong balance sheets, have the cash that can manage through these crises. This is going to be critical at this point in time. So let's take a look at what the roadmap looks like ahead, right? As we kind of move through this, there's two key things that what I like to call double D, right? The depth and the duration of this recession. Those are the two key metrics to help decide what kind of a recovery you're going to see, right? So a V shape means your depth is going to be, whatever the depth is, your duration is going to be short. and you're going to bounce right out of it. That gives you a V-shaped recovery, right? If you talk about a U-shaped recovery, your depth is going to be, let's assume it's the same depth as when you had a V, but the duration is going to be longer before you come out. That's what gives you a U. And then obviously the dark scenario is that you get into this recession and then it really doesn't, you don't really recover from it, and that's your L-shaped recovery. I've heard of I'm sure you've heard of other alphabets as well. I've heard of W as potentially one where you go down, you come back out, and then you go down again before you finally come out of it. I've heard of what I kind of like is the Nike swoosh, which is you kind of go down and it takes you a really long time to come out of it. So it looks like the swoosh sign of Nike. But whatever the alphabet is, so our fundamental assumption is that we're more likely to start to see a U-shaped recovery. So second quarter is going to be the worst, and then we start to slowly recover. In the third quarter, we start seeing towards the end of the third quarter, we'll start seeing recovery, and then in the fourth quarter, we do start seeing, and that kind of increases and builds up momentum through 2021. So what we're doing is we're tracking consumer behavior, because that's going to be really key. And especially now what's happening with China and Korea, there's a lot of attention being paid to that. And then containment and cure. Now, if we get an announcement tomorrow that says we've got a vaccine ready, obviously that changes the dynamics, right? You're going to start seeing people now. Then the next question is, how do you distribute that? How do you get it out to the people? Because unless people are fully vaccinated, you're not going to feel comfortable and be back to what we were pre-COVID. So there are certain kind of long-term considerations as well, right? I mean, none of these changes, when we talked about kind of the fiscal adjustments that the Fed and the US Treasury have made, those are not going to come without kind of long-term issues, right? We talked about moral hazard. The other one is fiscal deficits. You're going to see that even within Malaysia, right? Malaysia is having to spend a good chunk in order to help the economy recover, right? What is the offshoot of that? You're going to see likely inflation, because you can't pump out so much money into the system without seeing a negative impact. And then lastly, I would say longer term, there is a likelihood of deglobalization, right? I mean, as a planet, we have really benefited, and all companies, all countries, I would say, have benefited from the fact that we have each been able to do what we're really good at and have been able to buy what we need from every other country, right? That's the benefits of globalization and trade. Now, when you start shrinking or reversing that, or when you start worrying about your supply chains and the fact that a lot of your medications are coming out from another country, or the fact that you do not have enough capacity to make masks, right? When you start saying, I want to bring that all in-house to protect my people, what does that do? That increases costs and that creates delays, right? So when you see that, you're going to see some shifts. There are going to be some shifts, and these are going to be long-term implications that you've got to worry about. So let's see, let's take this one step further, right? When we're looking at what are the existing themes that we've been paying attention to, right? Digital transformation is a key one for us. We've been talking about this for at least a good 3 to 5 years now, that there is going to be a transformation in technology, and that is really going to be driving this, and it's going to continue driving this. Fintech, you're seeing a lot more technology push in healthcare. 5G is definitely one of those things. And then there are going to be new themes that emerge out of this, right? So let's take a look at e-commerce, for example. Now, e-commerce is not new at all, right? Especially in Asia. It is not something new. We've been buying things, we're a lot more familiar with it, but you're going to accelerate that adoption even more now, right? So if you think about, let's take an example of your grandmother and grandfather, right? They're always used to going to the wet markets and buying and doing their shopping. Well, they can't do that now, right? In a lot of cases, if they're living by themselves, they're going to have to figure out a way to get the groceries to them. So how do they do that? You've probably taught them how to use an online shopping, right? Either they're doing Lazada, or they're doing an online grocer, or they're going to jayagrocer.com, or some way, shape, or form, right? Which they may not have done in the past. So now you've done that. Now, they may still want to go back to the market, but out of every 10 trips, maybe 2 trips they're going to save and say, you know what, I'll just do it online. I don't need to go to the market. So that adoption is going to continue increasing. Entertainment is going to change. I mean, I'm sure all of you are using Netflix and binge watching all kinds of shows and movies, right? So that's going to continue happening. Travel might have an issue, right? Going forward, it might take some time, but does that change in terms of how you travel? Healthcare, the ability to see a doctor online. So there's a lot of new themes that are going to emerge from this. So just like in any crisis, right, there's always going to be different opportunities there. But when we're thinking of new themes, what I'd like you to think of is just kind of think of 3 things, right? One is, how are your habits going to change? And when I say like anything, your spending habits, how are you going to change your activities, right? Secondly, think about how your companies are going to change. How are they going to change their habits, right? Whether that means they allow you to work from home more often, whether we see more working from home, whatever those trends are. And then finally, think about how governments are going to change, right? How are governments going to change in terms of, do they start bringing in things more onshore, right? Do we start getting more protective about, does it become, are you going to start having a immunity passport as they've talked about, right? So how are those? So when you start thinking about that, you'll get a sense for kind of what are potentially some new themes that you're looking at, right? So let's see, how are we positioning portfolios and what are the actions kind of we're taking for our strategies, right? So just to take a step back, for those of you that don't know Franklin, I mean, we're a US-based company. We've got a global presence. We've got a tech team that is based entirely in Silicon Valley. And it's probably the only global asset manager that has its entire tech team based in Silicon Valley. And what do we look for? We're kind of looking for, I mentioned earlier, high quality companies, right? What does that mean? That means you want really good, strong management teams. You want really good, strong growth characteristics, a long-term sustainable. You want to have really strong balance sheets so that when you go into a downturn, you have the ability to manage that. Now, it's always, I mean, everybody says this, right? That we all invest in good quality companies. I find it very hard to believe that anybody's going to come to an investor and say, you know what, my investment strategy is investing in low quality companies, right? Nobody's going to say that. But what you're going to see now is how many people are really investing in good quality companies versus how many people just say they're investing in good quality companies. And you will see that in the performance of their portfolios, right? So, I mean, it reminds me of a really a quote that I like to use a lot, which is what Warren Buffett had said, which is, you only know who's swimming naked when the tide goes out in the ocean, right? So only then do you know who's really protected and who's not. So let's speaking of the 2 technologies, there's 2 sectors I'd like to talk a little bit more about. One is the technology sector, and the other one is healthcare. All right, so let's talk about technology for a minute. I'm sure you've seen this kind of floating around on the internet. It's kind of a joke, but it's not really a joke, right? So who accelerated digital transformation in your company? Was it your CEO? Was it your CIO? Or was it the coronavirus, right? And I'd say this virus has done a lot of things. It has accelerated adoption in technology. So let's take a look at the relative performance of technology as well, right? It has outperformed pretty much every sector in the S&P 500, right? We've seen that across the board. Now, why has that happened? Is because for a couple of reasons. If you go to the next slide, you'll see that the earnings potential of the tech sector has not only eclipsed everything it has done in the past, it's also become a lot more stable. So the volatility in those tech earnings has reduced. So let's take a look at what is this transformation really looking like through this crisis. So if you look at what are we doing, we're doing everything from home, right? We're shopping from home, we're socializing from home, we're educating from home, right? So when you're looking at shopping, you're talking about the likes of Alibaba, JD, you're talking about Lazada, all those things, Amazon, all of them are being utilized to an extent that they would not have, they would have eventually gotten there, but now it's even more, right? So it's being accelerated. Nike, for example, has planned to shut down all its stores in the US. It has gone to a complete online model in the US. Now, they're not doing that internationally as yet, but that's how powerful that online model is. Socializing, I'm sure all of you have got your Facebook, Snapchat, Instagrams, and the usage is probably increased, right? Education, I mean, as your kids have had to stay home, your schools are starting to move online, right? You're starting to do Zoom classes. I know my kids are doing that. I mean, they're online, they're doing classes online, and they're doing their tests online. So a lot of technology usage is going on, right? Now, let's take it one step further, right? Things that you never thought you could do, right? There was always this notion that you want to be able to sell. You need to be, as a salesperson, you need to be in front of your clients. David, the next slide, please. When you're looking at companies now, the ability to sell from home, right, is something that is being appreciated, right? Companies are starting to learn. So we've invested in our portfolios in a company called GitLab, which has no physical presence. It's an entirely online company. Now, GitLab is a private company, but it's a fully private company. I mean, a fully remote company. Now, you look at exercising at home as well, right? So Peloton, I don't know how many of you have heard of it, is a exercise bicycle, right? But what is their key feature is that they do, you see there's a picture there, there's a screen on your bicycle, and you can do online classes. And you're doing real-time classes with some friends or with an instructor. Entertainment at home, obviously, we're all very proficient at it right now. I mean, I think we've all been watching nonstop all kinds of Netflix shows and binge watching. But what's becoming more prevalent as we move on to the next slide, you'll see is they're working from home, right? I mean, can you imagine? We're doing this webinar now. I'm sitting actually on my dining table at home, right? Now, I'm doing meetings like this on a day-to-day basis. I'm sure, doing meetings. So there's technology there that's being adopted, right? So Zoom, for example, is the one that we're using right now. There's Microsoft Teams. Microsoft Teams has seen such a massive adoption and such high level of usage right now internally within companies that they had a really strong quarter. So you look at all these different, let's take healthcare at home, right? There's a company called Teladoc that does remote. You can visit your doctor online. Now think about the impact that has, right? I mean, if you're sick, the last thing you want to do is go and sit in a clinic where there's 20 other people that are sick waiting to see the doctor, right? So if you weren't sick enough, you might catch something else there. Now, if you have the ability to see your doctor online and he can diagnose you with a couple of simple tests or whatever it is, it's much more efficient. Your doctor probably can see a lot more patients as well. So there's a lot of these developments that are going to take place that you've got to be able to take advantage of. Cloud companies, this is a theme that we've been talking about for a number of years and taking advantage of it, whether it's the Amazon Web Services, whether it's Microsoft, with its Azure platform, whether it's Google with its cloud, and Apple. So there are all these cloud companies where the idea is you no longer need hardware support. You just need an ability to access stuff that sits in the cloud. So let's talk about healthcare for a second, right? At the core, right, when you look at healthcare, what is driving healthcare? It's the fact that we are all getting old. And the number of people that are getting old and the aging population is going to be doing a massive ramp up. So you can see here how large a percentage it's going to be of total population. You're talking about having over 2 billion people by 2050, right, that are going to be above the age of 60. So what does this aging population do? It brings with it all kinds of health issues, right? That's just the natural. So you're going to see an increase in the need for medical devices. You're going to see the increase in need for different therapies. So what are we seeing? You're seeing gene therapy. You're seeing new developments there. You're seeing more personalized medicine that's taking place. You're going to start seeing robotic surgeries take place. That's been going on now for over a decade. So if we kind of move on, I'd like to here's a couple of companies that we are invested in, right? Intuitive Surgical does robotic surgery. And if you haven't seen, there are some YouTube videos out there. It is fascinating. There's a doctor sitting in California doing surgery on a patient in New York. right? And they're doing it because there's a robot at the other end, and he's essentially controlling it from this side. So these are kind of systems that are in place that are getting smarter and better. And then obviously there's biotech that's coming around. There's gene therapy that are more targeted to finding solutions for specific health problems for you, right? It's not a generic thing, but it's a therapy that's developed just specifically for you. So let's move on a little bit. The next slide shows kind of our top 10 holdings in the tech fund. In the U.S. opportunities strategy. And what you'll notice is there's a lot of technology holdings here, right? Because that's where we're seeing a lot of the growth occur in the US. And that's where we're seeing a lot of the growth occur across the world, actually, right? So before I do, I'd like to kind of end with just a couple of key takeaways that I'd like to reiterate for you, right? What I'd say is you've got to focus on the long term, right? Do not get hung up with the noise in the markets going up 2%, down 2%. If you do that, you're going to drive yourself nuts, right? So focus on the long term. That's what we do. And history has proven that patient investors are always rewarded over the long term, right? But do not forget that there is likely to be a dramatic economic downturn in the short term. So 2020 is going to be a tough year, right? What does that mean? You look for signs of a recovery. That's what we're doing. And we expect, with all the fiscal stimulus, with all the backing that the central bank has provided to the US economy, that we should start to see a recovery in the second half, in the fourth quarter onwards. And I'd say always focus on your longer term assets. So with that, I am happy to take questions, Sean, and I'll turn it over to you.
Sure, thank you for the sharing. So now the group chat will be open for any questions. While we wait, in the meantime, I would like to ask also a question that the audience might be interested in knowing. So previously in the sharing, you've also mentioned about the adoption of global technology, and as well as the earnings per share increasing over time. At the same time, the valuations also could be on the slightly higher end. So for the audience, they might be interested to know if they will want to buy in, would the recovery or perhaps the resiliency has already been priced in? You are muted.
I might have muted myself. I think you're right. I think valuations are a key factor, right? And when you look at the bounce back in the S&P 500, right? From March 23rd up to where we are right now, you've had almost a 30% recovery, right? Could you argue that it has gotten a little ahead of itself? Absolutely. Absolutely, you can make the case that it is ahead of itself, right? You cannot have prices going up in the event that earnings are going to go down. So valuations are dramatically going to be expanded, right? So there's no doubt that is. Now, what I would also say is that it is incredibly difficult to pick a bottom, right? Every one of us likes to think and wants to be able to pick that bottom and say, you know what, when I'm showing that chart to my friends on a Saturday night at a party saying, oh, you know what, when the market dipped down, Ray, on March 23rd, that's when I bought. I'd love to be able to do that, right? The odds that you're really going to be able to do that are zero. If you do it and you get lucky, you're going to do it once, right? So it's very difficult to do that. So the way I approach it is you think about, so let's say you have, if your assessment says that within the next 6 months or the next year, we will likely see a recovery, right? What you want to do is think about how you want to invest or what amount you want to invest over that period. So let's take, for example, I wanted to invest $100 over the next 10 months. And I say, okay, you know what? Every month I'm going to put in $10. I don't care where the market is. I'm going to put in $10 in these funds that I like or this strategy that I like. So what that does, and it's a concept that's called dollar cost averaging, right? So what that does is if your market is high, which if you argue that it is high right now and valuations are a bit extended, the number of units you're buying in that fund are less, right? As it goes down, the number of units you're buying are more. So the key to this is long term, remember? And the winner in a long term game is not the guy that picks the bottom. It's the guy that has the lowest average cost. And that's the way you do. You have to have a process, you have to have a method, and to a certain extent, you want to take out your emotion from it, right? When you see the markets moving around, you have an emotional reaction to it, whether you like it or not. That's just human nature. And you want to take that emotion out of it, which is why you need to have a plan and you need to execute that plan without letting emotion into it.
Right. While we are on the topic of tech, there's another question. Would the valuations of the tech stocks in Asia provide maybe a better risk-reward opportunities compared to the US?
So I will say, I think there's definitely really good tech companies in Asia. There's no doubt. And there are, and if you'll see in the portfolio, there will be a couple of names that are invested in Asian technology companies. There's no doubt there's innovation and there's good ideas coming from everywhere, right? The focus is, our analysts are doing just that. Our analysts are global when they're looking at the investments. They're not just looking at one particular area. Now, obviously, the strategy that we're talking about tonight is the US strategy. So they are, by definition, they're focused on companies that are predominantly in the US. But does that mean that they're not looking at other companies? Of course they are, because they have to look at competitors, right? So just because an Amazon is really good, it doesn't mean there isn't a good, strong competitor out in China, which there is, right? So there could be, but given that this is a US strategy, most of the investments are focused on the US.
Right. Could you highlight perhaps some of the key market risks that you see not only on the US economy as a whole, but also perhaps maybe targeted towards the technology sector?
Key risks for the technology sector or the US. So I'd say the number one key risk, quite honestly, is globally, how do economies come out of this downturn, right? If we stay in this downturn for a long period of time, it's going to take that much longer for it to come out. And it's going to be that much more painful. So I don't think necessarily that, there are risks. Clearly, there's going to be risks, how long our recession lasts. For technology companies in particular, it's going to depend on who their end clients are, right? And how strong or weak their end clients are. So it all boils back down to how long does this recession last and what does that do to the balance sheets of these companies that are buying into it. Now, the other risk obviously is on the people side. What does it do to employment levels? What does it do to earnings levels? Because at the end of the day, if you don't have a salary, if you don't have an income, your spending is dramatically different. You're not going to be spending. Netflix does not become an essential service then, right? Your grocery store becomes an essential service. That's about it. So it is going to depend a lot on where and how we get out of this downturn. That's why you're seeing a lot of the economies trying to restart. That's why in the US, you're seeing a lot of the states reopening and trying to get the economy moving again. Because the longer you stay shut, the tougher it is going to be to reopen and the longer it's going to take for your recovery.
Could you maybe share perhaps what is your view on the US small cap?
US small cap, that's interesting. Small caps in general, right? When you think about it, they do not have any place to hide really. So when you go into a downturn, a small company, think of it as a small business, right? it does not have a lot of wherewithal to take a lot of the beating, right? So they tend to go into bankruptcies faster. They tend to they tend to have a lot more trouble. And so if you look at a small cap index, it's going to be worse performing compared to a large cap index because naturally you're worried more about the smaller companies. But the way you want to think about it is coming out of a downturn, those are going to be the companies that are going to be most likely showing the maximum snapback, right? So when you think about, take a simple math example, right? If you've got company A that has $100 million in revenues, and you have company B, which is a small cap, that has, let's say, $10 million in revenue, right? So if your revenue increases $1 million on each, it's only a 1% increase for the larger one, but it's a 10% increase for the smaller one, right? So you see that juice much more in a smaller cap. Now, it is always tricky. When do you get into small caps, right? At what point do you get into small caps? So you've got to balance that out. You've got to have a diversified portfolio. You can't be all in one area, right? Because if you could predict when the recovery was going to be, then I would say you go all into small caps and you go into as much risk as you can. If you can accurately predict when that's going to happen. But if you're wrong in that, your pain is going to be twice as much as somebody who's got a diversified portfolio. So you've got to balance that out. But as an asset class, I think small caps are very interesting because you need to identify a small company. And I'm a little biased because as you read out in my background, I manage small cap money. So I'm a little biased in that sense. But I enjoyed small caps because you find one product, right? And you know that that product is good. That can change the dynamics of that company dramatically. But if you find one really strong, good product in, let's take General Electric, for example, it's such a large company that one product is not going to mean anything, right? So I think small caps have a very, very exciting phase to it.
Great. I'm getting a couple of questions regarding the funds, the difference between Franklin Opportunities as well as Franklin Technology. Perhaps could you use this opportunity to explain, give a rough overview between these two funds?
Sure. So obviously, as the name suggests, so US Opportunities is a strategy that focuses entirely on the US markets. It doesn't really look at international markets, doesn't look at global necessarily. On the other hand, when you look at the technology company, that's global. And they are focused on only technology. Now, as I showed you in the top 10 holdings on the US side, it just so happens that a lot of the US attractive companies and the growth companies that we're focused on happen to also be technology companies, right? That is just a coincidence, but there's a lot of other companies in there. So for example, I talked about healthcare. Now, healthcare is a sector that is growing, that is attractive, that the US strategy can invest in. Whereas the technology fund would probably only invest in let's take a Teladoc, for example. The technology angle of it is all they would be able to invest in. Whereas the US Opportunities Fund could invest in a wide variety of companies within that healthcare framework. So you could invest in pharmaceutical companies that are showing good growth characteristics. You could invest in assisted living companies that are showing good growth characteristics. You could invest in some biotech companies as well. So that's the difference. The other difference I'd say also is just in terms of, both those portfolio managers, and I know them very well because I worked with them for a number of years. They're both part of the same team. So they're sharing a lot of the ideas, they're sharing a lot of the research, they're talking about, so they're all pulling in information from the same research team. So there is going to be similarities, and that's what you're seeing. But the technology fund focuses 100% only on investing in technology companies and can go global, whereas the US Opportunities focuses on a whole variety of sectors. They can go into real estate, they can go into healthcare, they can go into energy, they can go into anything, so long as it is based in the US.
Great. Looking at a more general point of view, like given the volatility in the market, especially on a year-to-date basis, as well as perhaps maybe the next 12 months. Would lump sum or dollar cost averaging for investment, which one would you recommend?
Oh, I mean that's an easy question. Dollar cost averaging, without a doubt, for a couple of reasons, right? So we talked about dollar cost averaging and the benefit of doing that and having that plan in place. But if you talk about being lump sum, once again, go back to if you think about that slide that I talked about, where I showed the time arbitrage. If you're investing in a daily basis versus investing, so think of that as a framework and think of that as an example for when you're investing. A lump sum investment is what I would equate to almost like a daily investment. You're making that bet now, right? That today is the day that the market has hit its bottom and it's only going to go up from here. If you're confident in doing that, that's the only way I would say you do lump sum. And I have not come across anybody, including some of the best investors, that has ever been able to call the bottom consistently. It's very rare. So lump sum is not a strategy that I would, recommend necessarily. I would definitely say dollar cost averaging, because it allows you to come in at your own pace and it takes emotion out of the equation.
Great. So guys, since we are in, there could be, since it's already time, so maybe we just touch on maybe just a couple more questions and then we'll end the webinar for today. So, Avi, could you kindly give your opinion on perhaps what is the economic implications of the Fed printing cash, especially do you think perhaps it will cause inflation in physical goods, or perhaps even this inflation could be tied towards the higher market valuations?
Okay, so the Fed printing money is definitely, and I hate using this word because it's been used so often now, is unprecedented, right? I mean, it is. The funny thing is, we said the same thing in 2007, 2008, when the Fed, at the time, the chairman was Ben Bernanke, and he basically started or invented quantitative easing. And then we did QE1, QE2, QE3, QE4, and we pretty much got hooked on to QE, right? There is going to be some kind of a negative reaction to this. Now, I subscribe to the view that when you print money nonstop, there's two things that are going to happen, right? It's like any commodity. You increase the supply of any commodity, what happens to the price? The price goes down, right? Similarly, once the price starts going down, that has a massive inflationary impact. Now, the one thing I will say is this was the same concern we had back in 2007, 2008. And we didn't see any inflationary impact to a meaningful extent. I don't think, when people say that there has not been any inflation, I don't think that is accurate. There has been inflation. The difference is that inflation is not something that we've been seeing, right? It doesn't show up in the numbers necessarily, but if you look at your healthcare costs, those have gone up, especially in the US. If you look at education costs, those have gone up. So inflationary impact is likely to be there. It won't happen immediately, right? So when you go into any crisis, the first thing that happens is deflation. Prices start to go down because there is no activity, right? But eventually, inflation will kick in if we don't reverse some of these trends. So there is that risk. But so far, we've not seen any evidence of it in the last decade, at least.
Great. So the final question is touching a little bit on US politics. So will the US presidential election create perhaps some more volatility to the market in the months to come?
No conversation on a US investment strategy is complete without talking about elections, right? Yeah, I think November is going to be an interesting time. And between now and November, there's going to be a lot of volatility that's created because between President Trump and the Democrats, they're going to be this tussle. Even if you look at it right now, I think there is some concerns being raised about, is there a political angle to why we're trying to reopen the states early, right? Because you need to get income flowing back into people's pockets, because if they don't feel comfortable economically, generally, it's very hard for a president to win a re-election. There has never been a time in American history where the economy has been doing well and a sitting president has lost. So it is very important, if President Trump wants to come back for a second term, which he does, he's got to get that economy up and running. He's got to get the US up and running. And it can't be that the US is up and running in the fourth quarter. It needs to be up and running and functioning in the third quarter, because elections happen in November. Now, who's to know? I mean, I saw a news article saying that there's some thought about potentially postponing elections. Now, that has never happened in the history of, but there's a lot of things that have never happened in history that we're seeing right now going through this crisis. I'm not saying that there's a likelihood of that being the case, but elections will create a lot of volatility. Now, embedded in that question, obviously, is which one is likely, which one is better. I don't think there's any really, there's never a right answer to that. It's never that the Republicans are good or the Democrats are good. What the markets at the core want is stability and continuity of policy. So long as Joe Biden has economic policies that make sense, I don't think the markets are going to worry about it. If you recall 2016, the day after Donald Trump won the election, the Dow was down 5% at one point, and then recovered and closed the day only down 2%. So after that initial shock of a new thing, people analyzed and said, okay, at the end of the day, this is going to be good for business. This can be good for, and the policies that he's talked about are going to be good for the business, are going to be good for the market, and therefore they've rallied from there. So it's, yes, it is going to create a lot of volatility, but I would say you pay attention to what the policies are and what are they talking about. And even in that, there's going to be a lot of noise. So like I said, volatility is your friend. If you have a proper, good investment strategy in place where you take that emotion out of the equation.
Great, and that ties, so we're in the webinar for today, and that also ties in to what you've mentioned earlier in regards to the, it's better, especially during market volatility, to implement investment strategy of dollar cost averaging, because you really can't predict when is the market bottom. So as a brief conclusion towards this webinar, we FSM One also thank Mr. Avi as well as the whole Franklin Templeton team for their efforts in attending this webinar. So for investors who are interested in gaining exposure towards US, you can perhaps consider Franklin US Opportunities, as well as the Principal Global Technology Fund. So for Franklin US Franklin US Opportunities, sorry, they have almost 20 years of track record, and as investors, we can leverage on their expertise. Not only that, as Mr. Avi has also mentioned, they look into many criteria, perhaps into growth, the quality, as well into valuation criteria before making their decisions into investing into that company. And also the US opportunities also invest across a wide variety of sectors, and investors could likely take advantage of that. In terms of the Principal Global Technology, it fits into the Franklin Technology Fund. So for investors that are interested, they may also consider that fund. So before we end this session for today, I would like to repeat that we apologize for unable to answer all your questions. But if any questions, please feel free to email investhelp.my@fundsupermart.com. I'll repeat that, investhelp.my@fundsupermart.com. So thank you very much, Mr. Avi. Thank you very much for everyone for attending this webinar.
Great. Thank you very much for having us.
Thank you.